Welcome to Rad Academy. If today is your first time on the channel, kindly subscribe to the channel for more videos. So today we are going to talk about the adjustment of final accounts. The adjustment of final accounts. That is the adjustments that we make to the final account. That is the statement of profit or loss account and the statement of financial position. So under this chapter, we're going to look at the accrued expenses, prepaid expenses, unearned income, and accrued income. So first of all, let me say that when we talk about the adjustments in final account, it refers to the changes or entries made at the end of the accounting period to ensure that all incomes and expenses are recorded in the correct accounting period, following the accrual basis of accounting. That is the adjustment to final account. So what this is trying to say is sometimes some of the payments or expenses or income are not related to a particular year. That is the year that we are preparing the financial statement. So if it is not related to that particular year, then it means we have to make some adjustment. That is, so when it comes to the preparation of financial statement, we we normally use the accrual basis and the matching principle. I've already explained some of the concepts in my previous videos. So normally when you are preparing a statement of profit or loss account and a statement of financial position, it's mostly based on the accrual basis and the matching concept. So with the matching concept, it says that we should match revenues, expenses with revenues in that same particular year. So if expense is paid in 2022, which is for 2023, we have to match the part that is related to 2023 to 2023 and match the 2022 to 2022. So that is what about the expenses that we are saying. If we have expenses owing and the expenses have not been paid yet, we still have to adjust it to that particular year. So that is the adjustment that we are talking about. This is not the only adjustment, but then for this particular video, we're going to talk about these four adjustments. We are going to talk about these four adjustments. Yes. So some of the adjustments that we have here is the accrued expenses, prepaid expenses, unearned income, and accrued income. So that is what we are going to talk about. So, and also we do this adjustment. We do this adjustment. We do this adjustment to ensure accurate reporting. We must adjust these items so that only the portion relevant to the current accounting period is included in the final account. That is why we do this adjustment. So sometimes there could be some payment or receipt of some income which is not relevant to the current accounting period. Therefore, because of the matching principle, we need to make adjustments for those items and record the ones that are relevant for that particular year only. So let's go through. So the first one is the accrued expenses. When we talk about accrued expenses is an amount of expense that have been incurred but not yet paid for. We've incurred the expense, but then it has not been paid for. So last year, for example, we were supposed to pay 1,000 Ghana cedis for insurance, and as at this year, we still haven't paid for that insurance. We call it accrued expenses. It can also be called expenses due or expenses owings or expenses outstanding or expenses unpaid. So expenses, so when at the end of the accounting period, when you are when there is expenses due or expenses owing, we add it to the expenses that has been paid in the that particular year. So for example, in the year 2024, insurance costs or insurance expenses 1,000 Ghana cedis. And as at that year, the insurance that we incurred in that particular year is 1,000 cedis, but then we have been able to pay for only 800 cedis. Now we have 200 expenses owing. Since that 200 is related to that year, we still, although we paid only 800, but then because of the accrual concept and matching concept, we still need to record it and present it in that same year. So we are going to write that we paid 800 insurance and when we are going to add 200 what owings, although it has not been paid for, but then we still have to show it that it is related to this particular year. So we add it to the one that we've paid to make it 1,000. So that is it. Then when we move to our statement of financial position, we treat that 200 cedis as a current liability. We treat that since it has not been paid for, we treat it as a current liability in the statement of financial position. So that is the accrued expenses. So let's move to how the expense account will look like. This is how the expense account will look like. So this is how the expense account will look like. So anytime there is an expenses and you need to make an adjustment for it, this is how the expense account will look like. So you open your T account nicely for the expense, then the amount that was paid for. So let's assume the amount that was paid for was 800. That is the cash book. So you credit your cash book and you debit your expenses account. So that is what you are seeing over here. So let's say the amount that was paid for was 800. But the amount that they were supposed to pay is 1,000 cedis. And out of the 1,000 cedis, only 800 has been paid, meaning we have owings left. So that owings is what we call the balance carried down. That is the closing owings. So that is the balance carried down. So you need to add back to this. You need to add it to this to make it 200. To make it what? And the total will be what? 1,000 cedis. So just like how we balance an account. If you are balancing this one will come here. So now if you are balancing this, then it means 100, 200 plus 800 will give us what? 1,000. So that 1,000 that you bring here is what we say it is what? Profits and loss. So that is the amount that you will send to the profit or loss account. So this is on the credit side of the expense account. When you go to the profit and loss account, you go there and debit this 1,000 cedis in that name of the expense, say electricity. So that is how we treat the expenses account. So here, the balance carried down here, 200, will be the same as the balance brought down here as what? 200. That is for the expenses account. Okay. So let's move on to the next. The next is prepaid expenses. We have expenses owings and we have prepaid expenses. So prepaid expenses is the amount of expense paid in excess of what has been incurred. That is, we've paid more than what we are supposed to pay. So if in the month of March we were supposed to pay a rent of 500 cedis and we are not yet in April, May, June, but then we've paid for April, May, June. We've paid the expenses in advance. So that is what we are saying over here. We've paid for the expenses in advance. So we are not yet in 2022, or let's say 2026, 2027, but then we've paid for the expense for the next year. So that is the that is the prepaid expenses. We've made a payment for the next year. That is the prepaid expenses. So so if there is prepaid expenses, there is the need for us to make an adjustment to that. So because if you are making payment for 2026, that is the next year, then it means that particular part or the portion of that amount does not relate to the current year, which means we need to make an adjustment to it. What we have to do is you have to less, when you go to the profit or loss account, you have to less, or you have to deduct from the expense that is paid in that particular year. So if in that year 1,000 cedis was paid and only 700 cedis is related to 2025 and 300 is for 2026. We are going to record this, but then when you are preparing your financial statement, when you write this 1,000 cedis has been paid, you need to come and less the prepayment, which is what, 300, and now we have 700, which is related to the current year. So all prepaid expenses are less. That is, it is deducted from the amount that has been paid, and it is treated as a current asset in the balance sheet or the statement of financial position. It is treated as a current asset in the statement of financial position because we have paid the expense, but then we have not enjoyed it. So since we've not enjoyed it, it's an asset to us. We've made payments in advance. It's an asset to us. So when you come to the profit or loss account, we deduct from the expense that has been paid, and that same amount, that is the 300, we move to the statement of financial position and treat it as a current asset. So all prepaid expenses are current assets. So let's look at how the account will look like. So that is, it's also an expense, but then this one is a prepaid expense. So that is, again, when you make payments, you credit your cash book, you debit your cash book. So that is what we are having here. That is what we are having here. So let me use that same amount again. So we paid for expense, which is 1,000 Ghana cedis. So we credit our cash book and we debit our expenses account. And there was a prepayment out of this 1,000 Ghana cedis. 300 cedis is not for the current year, it is for the next year. So since it's not for the current year, then we have to what less. That is the closing prepaid. That is the balance carried down, which is here. So we deduct the 300 by crediting the expenses account. Say here will be what, 300. Now we find the difference, and the difference will be what, 700, and that is what will go to the profit or loss account. Here will be 1,000, and here will also be what, 1,000. Sorry, this balance carried down should not be here. It should rather be here. So balance brought down. So this 300 will also come here. This should not be here. So that is how the expenses account will look like when there is a prepayment. Okay, let's look at the next adjustment. That is unearned income. That is unearned income. So when we talk about unearned income is an amount of revenue received in excess of the amount earned. Simply means the revenue that has been received in advance. Revenue that has been received in advance. What this is trying to say is when someone asked you to do a particular job for him or her, and you've not performed the job or you've not completed the job, but then the person has made payment to you. You've not completed the job, but the person has made payment to you. You've received your revenue in advance, although you've not completed the work. So it is only earned after the work has been completed. That is why they are saying revenue received in excess of the amount earned. It is only earned when the job has been completed or the goods has been transferred from your premises to the customer's premises. That is where revenue is earned. But then if the customer has made payment to you, but then their services or goods has not been sold to the customer or the service has not been rendered to the customer yet, but then you've received the money from the customer, it is called unearned income. You've not earned it. It is only earned after you've rendered the service to the customer. So this amount is deducted from the amount that you've received in your profit or loss account. So anytime there is unearned income, it is subtracted or deducted from the profit or loss account, and it is treated as a current liability in the statement of financial position, because since it has not been earned, it is a liability to you. You've received the person's money, but then you've not performed the job to the person, or you've not supplied the person's goods to him or her. So it's a liability to you. So on earned income is a liability, which is a current liability. So let's look at how the unearned income will also look like. So that is the revenue account. So revenue account, when we talk about revenue account will always be given. So that is why you are seeing cash book here. So if it is discount received, we are going to credit our account and debit our cash book, because we are going to receive whether in cash or in check. So we are going to debit our cash book and we credit our revenue account, say discount received. So if there is a, a an unearned income, the amount that we've received, we need to less, and we are going to less by what? Debiting it. So when we debit it, the difference that we get is what we are going to say profit and loss. So that difference is what we are going to transfer to our profit or loss account. Very, very simple. So the balance carried down here will be the same, as the balance brought down on the credit side. Very, very simple. Then we have accrued income. So when we talk about the accrued income is the vice versa of the unearned income. This is amount of revenue earned, but that has not been received by the firm. So here, the firm has performed their duty. They've sold the goods to the customer. They've completed the tax, but then have not received the money from the customer. Here, it has been earned, although the money has not been received. But since it has been sold, the customer has the goods now, or the firm has rendered the service, it has been earned, even though the money has not been received. So it is earned, but then the money has not been received. So here it is called accrued income or revenue owing. People are owing us some revenue. Here it is a current asset to us. So it's just like debtors. Some people are owing us. So it is treated as current assets in the statement of financial position. And when we get to our profit or loss account, it is added to the profit or loss account. It is added to the profit or loss account. That is based on the accrual concept. It has not been received, but then we still need to record. And it was received in that particular year. Since it is matching principle, we still need to record in that particular year. So that is the accrued income. Let's look at how the account will look when it is an accrued income. So again, we credit our cash book because that revenue is given and cash book will also be receiving. And since we are owing, we need to add back. So always we add owings back. We add to the one we've received, and the total will go to the profit or loss account. So here, when you are balancing this, this is where the profit or loss account. So here it is on the debit side of the revenue account, which means when you go to the profit or loss account, it will go to the credit side of the profit or loss account. That is it for the revenue account. We are going to take questions and you are going to appreciate it more. So follow. So sometimes in certain situations, we can have expenses and revenue owing and prepaid having opening and closing for the period. Yes, so sometimes there can be expenses opening and expenses closing, and there can be expenses prepaid. Sorry, expenses opening prepaid for expenses and closing prepaid for expenses. So when you have these two, it means there will be more writings in the account. So let's look at how that one will also look like. So when there is, this is how it will look like. So let me explain this well for you. Okay. So when there is, as I was saying, when there is opening prepaid, so this is the expenses account. That is, we are talking about the expenses account. So let's say electricity. Let's say the expenses here you are talking about is electricity. And you've been given details to tell us the amount that will be transferred to the profit and loss account. You open your account nicely and you have opening prepaid. That is the expenses prepaid opening. Expenses prepaid opening should come to the debit side of the expenses account. Expenses, again, I'm repeating it again. Expenses opening prepaid should come to the debit side of the expenses account. Someone will ask why. Because as I was saying, expenses prepaid, we've made payments in advance, so it is a current asset to us, and all current assets have a debit balance. That is why we are bringing the opening prepaid of the expenses at the debit side, because the expenses prepaid is an asset, and all assets have what? Debit balance. So if they are saying there is opening balance, then it should be on the debit side. If the opening prepaid is on the debit side, then it means the closing prepaid were. That is if the opening prepaid is on the debit side, which is the balance brought down, and it means the closing prepaid will be on the credit side. You just have to know this. Just know that is the most important is for you to know the opening. If you know the opening is on the debit side, then definitely the closing, that is the balance carried down, will be on the credit side. Sorry, it will be on the credit side. That is it. Then let's come to the opening for the credit side. So the opening for this one is opening owings. Opening owings. Why is opening owings on the credit side? Expenses owings is treated as a current liability. Expenses owings is treated as a current liabilities, and all liabilities have a credit balance. So if there is an opening balance, which is owings, expenses owings, then it should be on the credit side. So this will be given to you in the question. So if this is the opening owings is on the credit side, then it means the closing owings will be where? On the debit side. That is the balance carried down. So first of all, you write these things down. Then you come, how much was paid for that particular year? How much was paid for that particular year? Which is, so the amount that was paid in that particular year, you'll be told in the question. So it means that cash book will be what? Credited, and the expenses account will be what? Will be debited. So that is what you do. That is what you are seeing here as the cash book. So you come and debit the expenses account, the amount that was paid for that particular year. Then after that, you balance your account. So this time, you see, we already have because the question has already given you closing owings and closing prepaid. When you balance the account and the difference that you get, we are not going to say another balance carried down again. The difference that you get, whether it is on the credit side or the credit side or debit side, that difference is the amount that will be transferred to the profit and loss account. So this is an expense account. So definitely the profit and loss account, or the difference will be on the credit side, because since it is an expense, it has to be on the credit side of the expense account. Then when you go to the profit and loss account, it will be on the debit side of the profit and loss account, because mostly when you move to the debit side of the profit or loss account, there are expenses there. So this would be on the credit side of the expense account, and this expense, that is electricity. So let's assume the difference was 200. So this 200 will go to the profit and loss account on the debit side as what? Electricity, 200. So that is the adjustment we are talking about. Okay, we will take a question and you will appreciate it. Let's move to the revenue account. So now we are the revenue account. So with the revenue account, again, if we have owings and prepaid and you're asked to do adjustments, this is how we are going to do it. When there is opening owings, that is revenue owings. Revenue owings. Revenue owings is a current asset. So if there is opening balance for revenue owings, then since it is a current asset, it will have a debit balance. So the opening balance will be at the credit side. And if the opening balance is at the credit side, is at the debit side, then it means the closing balance will be where? On the credit side. So as soon as you see this, sometimes there will not be any closing owings. If there is no closing owings, don't worry about it. Just put the balance there. Then you put the balance there. So opening owings for revenue, it will be on the debit side. And closing owings for revenue will be on the credit side. On the credit side, opening prepaid for revenue, that is, you've received an amount in advance. That is on earned income. On earned income, which means it is a liability to you. All liabilities have credit balance. So what you do here is you credit the opening balance, and if the balance brought down is on the debit side, the opening prepaid is on the credit side, then the closing prepaid will be on the debit side. So here is supposed to be here is supposed to be cash book. Here is supposed to be cash book. So since it is a revenue account, it will be the one to give. So when you record the amount that was received in the cash book, you credit it and you debit your cash book. Then you balance it. The difference that you get is what will go to the profit or loss account. So yes, this will be the difference. So that is all for the revenue and expenses account. Let's try and take one question. Let's try and take one question. Let's take this illustration. It said from the data given below, prepare the electricity account for the year ended 31st December 2024. 1st January 2024, electricity owing was 200. The electricity chargeable per year was 1,000 Ghana cedis. During the year 2024, electricity paid was 800 Ghana cedis. Amount owing as at 31st December 2024 was 400 Ghana cedis. So let's prepare our electricity account. Please take note of the question because I might not be going back. So the electricity account. So let's open our electricity account nicely. So this is our electricity account. So we are taking this one after the other. He said, when you look at the first, he said on 1st January 2024, electricity owing was 200 Ghana cedis. So he said electricity owing. Ask yourself, electricity owing is what? Electricity owing is a liability. And all liabilities have what? A credit balance. So it means the opening balance will be on the credit side. It means the opening balance will be on the credit side. So balance brought down is 200 Ghana cedis. And the next one is that the electricity chargeable per year. Electricity chargeable per year is 1,000 Ghana cedis. It's 1,000 Ghana cedis. Then the next also said during the year, electricity paid was 800 Ghana cedi. If electricity paid was 800 Ghana cedi, it means it is cash book that paid. It means you will credit cash book 800 Ghana cedis. Then you come and debit electricity because electricity account will be what receiving. So we say cash book. So what they are trying to say is that year they paid electricity 800 cedis, but then the 800 cedis is not for that particular year. 800 cedis is not for that particular year only. What they are saying is for every year they pay 1,000 Ghana cedis, but then that particular year they were able to pay 800 cedis only. Do you get it? So, and they also said the amount owing as at 31st December was 400 Ghana cedis. So you see, we already have 200 at the beginning of the year. We already had 200 that we were owing. and we were supposed to pay 1,000 Ghana cedis and pay these 200 cedis, but then out of the 1,000 Ghana cedis, we only paid 800 cedis. Now we have another owing, which is 200 cedis. That is why they are saying, as at the end of the year, we are owing 400 cedis. So that 200 that we couldn't pay in last year, and the 200 we are already owing, which is what? 200, making it what? 400. That's why they are saying, as at the end of the year, we still had 400 Ghana cedis being paid. So they are saying that amount owing as at 31st December 2024 was 400 Ghana cedis. And we know that expenses owings opening is on the credit side. So it means expenses closing will be on the debit side. You have to just know this. That is how it is. So if you know the expenses owings is on the credit side, then expenses owings will be on the credit side, which is what? 400. So when you balance this, this will give us 1,200, and this will also give us 1,200. So means, so here the difference will come here. So the difference is what is going to be transferred to the profit or loss account. Please don't come and write balance carried down. It is the profit or loss account. So the difference between the debit side and the credit side is 1,000 Ghana cedis. So it means 1,000 Ghana cedis is what will be transferred to the profit or loss account for the year 2024. That is why the question said the amount chargeable per year is 1,000 Ghana cedis. So we've made the adjustment, but then you still see that it is 1,000 Ghana cedis that had been transferred to the profit or loss account. Yes, so that is all for this. That is all for this. So for now, we are going to end here, but then I will encourage you to subscribe to Rad Academy. I'm going to bring more questions and solve with you for you to get a deeper understanding of what we are doing. So for now, subscribe to the channel Rad Academy for more videos, and also share for your friends who also have a benefit of this channel. See you in my next video. Bye bye.